Hire an AP person.
Okay,
All right.
he's in.
Oh, perfect.
Okay.
Good evening. I'd like to call to order the meeting of the Redondo Beach Budget and Finance Commission, December 8th, 2022. Doug, can we do a roll call?
Sure. Commissioner Conroy,
Here.
Commissioner Castle,
Here.
Chair Marin,
Here.
Commissioner Woodham,
Here.
Commissioner Sullivan,
Here.
and absent tonight is Commissioner Chesty and Commissioner Samples.
Great. Let's take a moment to salute the flag. Please stand. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. So first up is item D, approve the order of agenda. Can I get a motion to approve?
So move. Second.
Moving on to item D, item E, blue folder items. Doug, can you confirm there's no blue folder items this evening?
Correct, there's no blue folders tonight.
Great. Moving on to F, consent calendar. Does anyone have any comments or want to pull anything from the consent calendar this evening?
I'd like to make a comment about the minutes, please. When I reviewed the minutes, when we had the investment presentation from the city treasurer last week, we had asked if the commission could get a copy of the monthly investment reports that were being distributed to the council and the mayor. And the treasurer first said no and then said, I'll think about it. That request was not reflected in the minutes, or I didn't see it reflected in the minutes. And I know it's a summary and it's not a direct, but I think that's an important point in case, because I think that all of us would like to have that be seen in our monthly meetings, or at least quarterly, to help us get ready for our annual reports. So if we can have that reflected in the minutes, please.
Okay, would you like the minutes revised and come back for the next meeting? Or do you just want to make that point for the record that?
I think it'd be important to have it in the minutes, so I would make a motion to continue item F2 until our next regularly scheduled meeting, and ask that the summary of the meeting be amended to include the commission's request to see monthly investment reports.
Okay, so we'll bring it back to you next meeting.
Okay, thank you.
With that.
Do we need to vote on that?
It wouldn't hurt if you guys want to.
Okay. Just in case. You said second?
Yep.
All in favor?
Aye.
Any opposed? So moved.
Thank you.
Any other comments around the consent calendar or the minutes? Can I get a motion to approve the consent calendar?
Move that we approve the consent calendar.
Second.
All in favor?
Aye.
All opposed? Motion carries. Item G, excluded consent calendar items. There's none. Item H, public participation on non-agenda items. Are there any comments or e-comments, Doug?
There's no comments or no participants on Zoom to comment. There are no e-comments.
Great. All right. Moving on to, let's see, what is it? Item I, nothing from the previous agendas. Then to item J1, to receive and file CalPERS update and path forward presentation. Are we ready to kick that off, Doug?
Yes, we have David Takeharts from CalPERS. He's going to do a presentation for you tonight. David, can you hear us?
Yes, I can.
Okay, perfect. Thank you.
Thank you. And thank you, members of the commission. Happy to be back and sharing an update on CalPERS. I wanted to take a moment to just thank Doug for his graciousness in working with me on this. We've had some exchanges and I had some technical problems. He was able to work it out. So thank you, Doug. Doug, are you able to share the slides that I sent over? Do you want to do that, or are you wanting me to do that? I don't know what's your preference there.
Sorry, I didn't, I have it loaded on my end, but it's on the other computer across from me. So if possible, could you share your screen?
Yes, no problem. One moment
Okay,
here.
thank you.
One moment. Let me pull that up. I just closed it down because I was like, oh, I bet Doug's going to show this. I don't want to have two different presentations up. And here we are. So hold on a second. Where is it? Let's see here. Okay, are you able to see?
Yeah, we see it now. We see it now.
Okay. I'll kind of go into slideshow mode here. And as we, okay, I can't really see anybody on the side. So if you have questions or want me to stop, please just verbally interrupt me because I really can't, on my little setup here, I'm afraid I can't see a whole lot while I share. So don't be shy.
No problem.
All right. So I'm going to walk through, I thought it might be helpful to talk kind of at the high level about what's the overall market environment that CalPERS is operating in. As I recall, several members either have a financial background or are just interested in kind of like the global macro picture. But if you want me to speed through that, I can certainly do that. Just let me know. But I seem to remember that there was some interest in that. So I'll tell you kind of what we're doing, kind of the latest developments, some challenges that we're facing, that everyone's facing, and what our investment strategy overall is moving forward. And then we'll kind of narrow the funnel and talk about the city's pension plans, the work that you've done to pay down your unfunded liabilities, how that fits in with the normal costs. And again, I'm very flexible with all of this. This is not a canned presentation. I can definitely go faster or slower, skip things. So at the pleasure of any of you, just let me know. And certainly anytime you want to ask questions, I'm happy to do that. So kind of at a high level, I don't think I'm going to surprise anybody here when I say that this is a volatile year of markets that we've been working in, starting with COVID, had a huge dip and then a huge explosion up in virtually every market. Starting with 2020, reaching all-time highs in the Dow and the S&P 500 and any other kind of measurement. And then, wow, the bottom really fell out. Last year, this time, CalPERS was looking at a 13% return, right at the kind of towards the middle and end of December, 13% return. And by the end of the fiscal year, which is a mere 6 months later, the final results for the year came in at negative 6.1. So just a truly difficult to think of another example besides the great financial crisis itself, where you saw a dip that's so precipitous, so fast across so many markets. And CalPERS, our position is really as a global investor. So there's no sugarcoating the fact that if the markets as a whole are going to go down, CalPERS does not have some super secret investment strategy that just boosts us up and pole vaults us into a positive territory when the rest of the investment universe is suffering, I'm afraid to say. So just lots of things happening at once here, just that it's confounding a lot of investors, a lot of economists. One of the big things is the correlation between simultaneous drops in bonds and stocks. Those of you who've got really some investment acumen and background probably have heard of the classic 60-40 portfolio. This is what grandma invested in because it worked over time, and kind of like the classic strategy, 60% bond or 60% stocks, 40% bonds is kind of the general theme, because if one area goes down, the other one generally kind of like cantilevers up and balances that out. Simply not the case in the last year. We've seen really a decoupling from that traditional pairing. That has really shaken the ground that CalPERS invests in. We don't think that that's permanent. And the big thing for us, in dealing with all of these issues, I kind of map them out there, just things going on in the world that are all sort of intersecting and creating a volatile and challenging market. For us, the big thing as a pension plan is to have a plan and to stick to it. That's key for us. We're not built to be a reactive investor. We are not we have neither the audacity, the bravado to think that we can time the market, and are really not set up the way that our investments are handled to even be able to do it if we wanted to. We could not just market sell all of our shares of Meta or Netflix or name your stock. Like, all of this is kind of spread out across a vast array of internal and external funds, very few just individual holdings. We can list it out that way. We can kind of do the math and say how many shares of Exxon or whatnot do we own, but it's really deployed in the most kind of diversified way possible. So
David?
for us, yes.
I'm sorry, a quick question before you go much further. When you talked about the negative 6.1% rate of return, is that the net rate of expenses or is that the gross rate? It's not quite framed that way for us. I want to show you, let me pop ahead just one slide here. I said negative 6.1. At the end of the day, kind of like gross of administrative expenses, and especially bringing in the results in the private markets, the actual return that you're going to see in next year's actuarial valuation, the overall rate that will be used to calculate your city and every other of the 4,000 plans in CalPERS will be negative 7.5. So it's not quite as neat and tidy as gross versus net. It's the problem for us, or the problem isn't the right word, but when we announce our fiscal year returns, the true quote investment returns, those always are kind of on a lag on the private assets that make up something like 20 or so % of the fund. Those are difficult to value. There's no like stock ticker to price these privately owned companies because the shares aren't traded in that way. So it takes an extra 3 months or so to capture that. And then as you're kind of alluding to, like, then we kind of get those administrative expenses figured out and a few other pieces, and that comes up with the final number. So usually it's very small. Usually it's, a couple of decimal points. This year, just because of the radical volatility involved and the radical changes, it was not insignificant. So it went from negative 6.1 to even worse, negative 7.5.
David, a follow-up question on that. So the negative 6.1 is net of regular management fees, just not net of private equity. Is that what you're saying?
That is a fair statement. That is a true statement. It's not quite complete, I would say. I might need to, let me just say, this is an ongoing conversation at CalPERS, is how to sort of, what's the correct nomenclature almost to describe what's happening here? Because it's not just quite administrative, it's not just quite the lag on private assets. So I may have to, if you're really curious, I may have to come back with a properly, fully vetted response for you. But that's the general gist. And unfortunately, it does not, the end of the story is not really in the city's favor, because it was an even more dire outcome than previously hoped for.
Okay, a follow-up to that point. If you could, it'd be helpful. I've got data going back 15 years that I think I got off the web, and I'm sure that data is incorrect, but it's by fiscal year. If you could be so kind as to send us by fiscal year the actual returns, at least for 10 years, and I'd say for 15 years, that would be very helpful, because I'd like to keep that in my records to know what that is.
Yeah. So specifically, you're calling out like the final number.
Yeah, final number for each year, each fiscal year, going back 15 years. If you could send that to Doug and have Doug could then get it to us, it would be helpful.
I will do that. Yes.
Thanks.
Yeah.
David, do you know off the top of sorry, Jason. Do you know off the top of your head what the private equity management fee was for last fiscal?
No, I don't know that off the top of my head, but I can find that.
Thank you. Sorry, Jason.
It's too high is the answer. I think we'll see, but yeah.
David, so you said we went from a negative 6.1 to a negative 7.5 for this year's presentation. I think if whether we have good news or bad news from where we start to where we finish, I think it would be helpful to this organization to have that path be a part of the presentation. This is 6.1, and then these things happen, and that's what gets us to 7.5.
Thank you. Yes, I agree. And I will, I accept that feedback. Well, I did skip ahead briefly, but I won't belabor this. I think you get the point here on this particular one. What we at CalPERS, and it's not always easy, and it's not very satisfying, I think, to a lot of folks, is we really want to avoid giving way to the temptation to try to say, okay, the world has changed, markets have therefore changed, our strategy needs to really be tossed out, and we need to scrap this and figure out, okay, where do we need to put the money now? Let's react to this, and let's try to figure it out and be smart and really outsmart the markets. That's really not the approach. We want to continue on with the disciplined approach for the large bulk of the asset allocation while trying to bring in some innovative ideas. But frankly, those are going to be sketching along the edges. Those are going to be trying to seek alpha along the edges of a grander strategy that is still endorsed by the board, endorsed by our chief investment officer. And we have got a new chief investment officer since the last time I talked to you. I want to say that just based on the timing, we were still kind of in the search mode last time. So we did lock in a new CIO whose specialty is all private markets. So that's where the innovation and kind of like pushes for newer innovative approaches to try to find new niches and to scoop up money that's out there that in the past we haven't been touching. The core strategy is going to be very, very similar. And it's going to be that sort of boring, long-term stocks and bonds approach. Skip this one for now. The question that we worked on through so we go on I would say, if I would back up, we go on a 4-year sort of like view of our what's called the asset allocation process, our asset liability management process. How much money is allocated to the major segments of the CalPERS investment pie. And we, this is a policy adopted by the board. It's been in place now for over a decade. It's a self-imposed policy. It's the board and staff saying, we want to really make it difficult for us to have knee-jerk reactions to market movements, even protracted market drawdowns like we've been in here, even recessions. We still want to have decision-making kind of like undergirded and guardrailed by this 4-year process. And that process just ended, basically a year ago. So like we're now trying to implement the stuff from decisions made last year. And here are the kind of things that were really being balanced. This was the question for the board is, what's your tolerance for drawdown risk? How aggressive do you want to be? How much volatility can you accept? Because if you want more of those things, then it's all about calibrating that with the amount of private assets. So for us, that's private debt, private equity, and real assets. We kind of group those into the category of private assets. And then leverage, a word that nobody likes, a concept that immediately evokes the idea of investing on a credit card or levering up 500% and shooting for the moon. Concepts that are nerve-wracking to a very conservative stakeholder and public audience here. And the board and the staff at CalPERS are also very fiscally conservative. So that was the conversation. It's like, hey, if we want to keep employer rates as stable, or we want to do what we can to try to take pressure off the employers, how much risk are we willing to swallow, basically? That was really the question. Like, what's our risk tolerance? What's our appetite for that? Do we have adequate risk management in place to handle that? And then really the trade-off was, do you want more private equity, and are you willing to build leverage into the fund? And ultimately the answer to both of those questions was yes. Yes, the CalPERS board is willing to take on more private assets. Yes, we are willing to build in a baseline of at least 5% leverage into the fund. So that's what this chart shows you here is, there's ways to dig this down further. And it sounds like there's probably some interest in seeing like the granular detail, but these are the biggest kind of slices of the investment pie that the way you can group them. So global equity being all types of stocks. There's cap weighted, there's factor weighted, there's different ways, but in general, you can see that before the ALM process, 50% of the fund was in broadly stocks. In our new asset mix, that's been reduced by 8%. That money, if you kind of look at this, fixed income, a little bit more to bonds and treasuries, but not much. The real changes here is more money to real assets, a lot more money to private equity, from 8% up to 13% of the fund, and from virtually nothing on private debt up to 5%. And so when we're talking about, keep in mind the PERF, the pool of assets here is, hovers around, 440 million up to 440 billion up to nearly $500 billion. So when you're talking about 5% of that, I mean, it's $20 billion. So significant. And the challenge, of course, is that none of those last three are a matter of pressing a button and the investment occurs. These are things that require deal flow. These are relationships with a very limited number of people who have control over these assets or access to them. And that's why we thought it was such a big get for us to get a CIO in place who comes with these bona fides, who has led the private equity program for the biggest private equity investor in the Canadian pension sphere. Canadian pension funds are very highly allocated to private markets and have been for decades and decades. They were kind of the vanguard of all that, and they reaped the benefits of that. They really scooped up a lot of the low-hanging fruit, and we're hoping that she can duplicate that success here. And like, we made other recent hires that are, everything is about private assets. If I had to say, like, this is where there is more money to be made, whereas really with global equity and fixed income, we basically perform the way that the market performs. A little bit more or less every now for some points, but by and large, how the market goes, so goes CalPERS. With the private stuff, that is all human beings making deals, and so we're trying to put more capital there.
David, question on leverage. How do you operationally put leverage in? Are you just borrowing 5% and investing that?
Yes. So for us, it's borrowing. It's sort of like the most boring version of leverage is how I've heard it described by us and deployed. So we've always, in fact, before all this decision was made, we were already at 4% leverage, and people were kind of surprised at that. So this only upped it a little bit, but it's all being done within the fixed income sphere. So we're basically leveraging the most traditionally conservative asset class, fixed income, which is bonds and treasury bills. So we're kind of borrowing against that to invest in more of that. So not a very exciting path. This did get some pushback from stakeholders, though. I think that conceptually, leverage, and to a degree, private equity is also not a beloved approach. There's a lot of folks thinking about CalPERS. There's a strong, union labor influence in CalPERS, as there is throughout California. And, traditionally, unions are not huge fans of private equity as a general concept because it's believed to be, negative towards labor, and people lose jobs as companies get, downsized, et cetera. Anyway,
David,
yeah, so some pushback on that.
Yeah, before you jump in, another quick question, please. You talked about your cycle for rebalancing being 4 years. That, if I remember correctly, coincides with the reset of the rates for your members as well, the rate of return for your members, or is that on a longer cycle?
It's all part and parcel. It's all the same. So the determination of are you talking about the discount rate? Is that what you... I want to make sure I understand what you mean by the rate for your members.
So previously it was, say, 7%, and then it might get reset to 6.5%.
Yes.
Actuarial assumption.
Yeah, the actuarial assumption, discount rate, target rate of return, sort of all aspects of the same thing. They are inextricably linked. So when we review the discount rate, that's based on kind of like the projected capital market assumptions that we kind of glean from the investment universe and our investment staff. And that's where the board says, okay, over the next 20 years, this is kind of where we think these asset classes are likely to go. Ergo, if we want to, here's what the discount rate would spit out if we left it as we are now. If we wanted to keep the discount rate higher or only drop it a couple of basis points, here is the asset mix that would go with that. So it's really two sides of the same coin. Like by dropping the discount rate to 6.8, that necessitated basically that the strategic asset allocation that you see here on this slide occurred. And in a way, vice versa, like that this particular asset allocation should over time generate an average of 6.8% return based on the best information that we have. So hope that answers that.
What is it a 4-year cycle also for the discount rate, or is it a longer
Yes.
or shorter cycle?
Yes.
Okay.
It is.
And
It's a 4-year cycle. There is one, if I could, there is one caveat there. There is something called the funding risk mitigation policy that's in place. And that is when in kind of like really kind of banner years that we have where we exceed the target rate of return by a certain percentage, then the policy calls for the discount rate to then be automatically lowered by a commensurate amount. So the idea being that when we have really good years, you kind of like winning a big pot. Not that we're gambling, but like when you win a big pot, you kind of take a little bit of the risk off the table. That's essentially what that policy tries to do. And ironically, coincidentally, that happened the same year, last year, when we were doing the ALM policy reduction. So the policy had called for a reduction from 7 to 6.8. We went through this whole process, and 6.8 was the number kind of spit out by this other process. And so you had like this perfect synchronicity. But there is
That's where I was going, was that in
Yeah.
bad years then, we're going to go back to our members and ask for greater contributions. Yes?
all things being equal, yes. In bad years, yes. The good news about like when the policy hits though, it would only take effect in years where there was going to be some relief to the employers and to the PEPRA members, in fact. And by lowering the discount rate during that kind of like banner time, like the feast years, if you will, it takes money out of that, but there's still relief, but just not as much as there would have been, if that makes sense. So yeah, I had some slides on this before I can send over, but it just shows you that like, yeah, if you had in really, really good years, the funding policy that isn't in effect would have allowed you to save more money in contribution rates. You still end up saving, but not as much. But ultimately, the risk to the system as a whole and theoretically future volatility is also reduced for the employer.
Yeah, well, just for planning for our city as a member, that's usually a lagging accounting. That true up is in the future for us, but we can forecast it by watching what the returns are currently.
Yes.
Okay, thank you.
Yeah, David, before we leave this area, you talked about leverage. 5%, you're borrowing against bonds and you're buying more bonds. What impact does that have on expected returns? How many basis points of an increased return do you expect from that?
I don't know exactly what the expected difference there was. I can find that out. It was more about lowering expected volatility. So we had a slide from one of our board reports that shows that, so I'll make a note of that. It really wasn't about, but the main point is that it wasn't about this is going to earn us so much more money. It was a way to sort of lower the volatility that we saw, because all of these projections come with a range, and the kind of the further out in time you get, the higher range of outcomes there are as things become less and less certain in the future. And just this leverage piece slightly narrowed the high and low ends, especially the low end of what the range of outcomes would be. But I will make a note and send that to you.
Okay, thanks.
Couple things, David.
Okay.
Our city treasurer comes in every quarter and gives us a report. And he always starts it off by saying that the primary objective is capital preservation. And this looks like it's a significantly different approach. I would just ask you, what is the primary objective of this portfolio mix, or what is it that you're trying to accomplish here? Because clearly it's much riskier than what our treasurer shows us.
Yes, I would agree. And there are, like, the primary mandate is to be able to fund benefits for members of the system. We're talking about the human beings who actually ultimately receive pension checks. But like a close second is the ability of employers to pay. And so those are not the same thing. The more certain that we make members' pension checks, the way we make that certain is by dropping the discount rate to whatever the 10-year treasury rate is, dropping the discount rate there and saying, whew, we will hit that return. We will hit, whatever that is today, 2%, 2.3. It's been rock bottom. Like that would honor that mandate. I mean, that would get those pensions paid. Unfortunately, about half of the cities in California would go bankrupt, and the other half would be doing massive layoffs or any other massive haircuts and things to do, because their expected costs would be just through the roof. They would double or more. So that's the balancing act here. There is, for sure, a lot of risk in the system, in the portfolio. That's why, we're trying to get more money into what we consider to be the highest payoff for the risk that we take, which we think are these private assets. And so that's the motivation there, is when we take risk, we expect to be compensated for it. And by extension, securing the members' benefits and hopefully keeping your costs low. But that piece for the employers is so powerful to us. And that's something that our CEO goes out and talks to the League of California Cities, works with the Association for the Counties and all the, like, just yesterday was at the Municipal Finance Institute of the League down in Monterey. And, that tension is real, these people, everyone involved in this is pretty much a fiscally conservative person. Like, the people that are in city finance generally are not gamblers and are not just saying, let's put it all into Bitcoin and everything. Like, they're not saying that. But on the other hand, we have to live in the real world of, my God, somebody has to actually afford to pay for these, and the city still has to be able to deliver their core services. And so that's the tension. So it is there is more tolerance for risk than we would like to have, but that's the necessity.
It does seem like a tough spot to be in.
Thank you.
Yeah, well,
I mean, it's tough for almost everyone involved.
However, I'm personally, I'm a little concerned about the increase in private equity. Now, you said that the person making these decisions had success previously with Canadian, and there's probably a lot of energy companies up there, which kind of really took off. But private equity long-term has had some pretty good returns, but in the last 15, 20 years hasn't been all that stellar when compared to just the overall global equity market or the U.S. equity market. So it just seems like a kind of a big bet on something. It appears to be a lot of additional risk added with maybe not as much potential upside, but I guess time will tell. But help me out with this part, because you alluded to it a little earlier. When there is a shortfall, then the employers have to just contribute more. Help me connect the dots on this. You guys are taking on this additional risk, but if the bet doesn't pay off, then the employers end up covering it, right?
Yes.
So it just seems like
that's where we're
if
trying.
things go well, then you guys are hero. You know, you guys look great. And if the bet doesn't pay off, then you kind of have a safety net with the employer contributions. Is that right, or is there more to it than I'm not considering?
I think you're right. I might phrase it a little bit differently, but there's no doubt that the employers backstop this system. I don't believe that even the most grizzled labor partner would argue that. It's a matter of fact. It's not really a matter of opinion. If the investment returns are lower than expected, it is not the majority of members who see increases, and even the ones that do, it makes up a fraction of what the employers end up paying as a delta. And so that's why I can say with confidence and I'm, with pride that over the last 8 years now, which is when our CEO, Marcy Frost, has been in place, she has really worked hard to be as transparent and open and receive input from the employer community on helping us define what is the acceptable balancing point between these competing priorities of not wanting to be so exposed to risk that when we have bad years like we just had, that the employers eat all of that and their future contribution rates skyrocket and it jeopardizes it. This is not the case for your city, as you all well know, and we'll lay out here in a moment, but like there are many cities that especially repeated bad years, especially negative bad years, it genuinely puts them at risk to where they have to make some difficult choices, like very difficult choices. So what's you did, and I'm impressed, but they so that's we have worked to try to find, okay, employers, what's the acceptable level of risk for you, to where, and like they just need to, you as an employer need to understand that you do backstop it. And so when folks say lower the discount rate because it's too risky, that does immediately and automatically raise future employer contribution rates and exposes you more. But when theoretically, as we reduce the discount rate, what that means is that there's less risk in the system. Ergo, when there's a bad year, it shouldn't be as bad as it would have been. So like, what's the right balance there? And that's the effort of this 4-year kind of like calibration cycle. And it is definitely a art and not a science. There is no magical formula that guarantees the perfect outcome. It's just constantly being sort of like rejiggered to make sure that it's, as close to a ball. We're looking through our crystal ball, but it's through a glass darkly. I mean, nobody can know. Like nobody saw this year happening the way it's played out. So that's the challenge.
David, quick curious question. What's the size of our portfolio? I know you guys manage a portfolio of over $400 billion, but I'm assuming that at some point you break that down, each member knows what the size of their portfolio. What is that for Redondo Beach?
That is not really, I mean, we could talk about your unfunded liabilities were briefly zero. It doesn't quite work that way, where I could say Redondo Beach's safety plan has X percentage in stocks versus bonds. If I'm understanding the question right, that's not quite how it works. It's more like all these assets are pooled, and then your percentage share of that, is then reflected in how our investment performance is. That's how we sort of allocate that out. And then that's chopped up to determine your normal cost and unfunded liabilities. So if I'm understanding you correctly, I would have to say like, that's not quite how it works behind the scenes for us. Okay.
I have one quick question back on that. We've switched the allocation, so in theory, our expected return is going to be a little bit higher. You said currently we don't have any unfunded liability because of the bond we did, correct? Is that correct?
I pointed correction on both of those. Okay. So by adjusting the allocation, what we did was take some risk out of the system, but the ultimate outcome was lowering the discount rate from 7 to 6.8. All things being equal, lowering the discount rate increases cost to employers. It just so happened that as we were doing that reduction, CalPERS happened to have a very good investment return year where we tripled up the target goal and got 21% And so the city did see relief in projected costs there. So, but it really was just coincidental that occurred.
Okay.
And then lastly, I did mention that's kind of getting ahead of the game here, but I'm sure many of you were involved in this decision, but the city took out in my opinion, rather large pension obligation bond and paid off the unfunded liabilities. So the thing is that the story doesn't end there. Like life continues to happen and CalPERS investment returns will impact the UAL for good or for bad going forward. And so we'll talk about that. But that's what I was alluding to there is you guys took a massive bite out of the problem. So.
To his question, when we did that, our funding ratio was what, 100%?
Yes.
Okay.
Better than, in fact.
Yeah.
When you did it, it was 100%. Then you were, and I had a conversation with the city manager earlier today. Briefly, then you had a nice surplus, and then it's just through really just bad luck, bad timing, that immediately the market turns upside down, and now you've got a small unfunded liability again.
Or good luck.
We could call it good luck, yeah.
I mean, yeah, sure.
Yeah.
The point is, you got it.
What if we hadn't?
Right? Yes.
We have, it's far more predictable. And
This
then
is you guys
for
have
the
actually.
CapEx, for the CapEx, it's far more manageable than it would have been otherwise.
Yeah. This is I had a good time looking through your materials, and I had a bunch of conversation with actuaries. Anyway, you guys don't care, but like your city has stimulated a lot of conversation on the CalPERS side. It's kind of a fascinating case study. Anyway, but we can look at that later. All good stuff, but just like, that's how it's kind of like, because I was kind of trying to unwind where the decisions came from and try to figure it out. And very interesting for me.
We had a whole subcommittee about it.
I bet you had some vibrant conversations about, I mean, we're talking about a lot of money here, but yeah, the timing looks to have worked out. I mean, I'm not supposed to have an official opinion on POBs, but it looks to be a pretty good call. Okay, well, I can zoom through here. I don't know, is there another item on the agenda? Am I eating into someone else's time here, or?
It's the city manager. He's looking at us now, but he doesn't appear to be scowling.
Okay.
Yeah.
All right.
I think the city manager is very interested in this kind of conversation anyway, so if we go over time, that's okay.
This
Okay,
is something that it's of great interest to all of us.
Very good. Bunch of pension wonks here. Very good. Usually people's eyes are kind of glassing over. But. So just moving the rest through this, and then we'll get into the city in particular. So to the committee member who just kind of voiced some concerns about private assets in general, you're not alone. And I'm not even saying that you're wrong necessarily, or even close to that. I may even agree with you, but here's the rationale from our perspective, like really what we think is important about these classes. So as I said, they have traditionally been the highest returning asset classes, both past and projected. So the way that we're framing it, and I agree there, on any given year, it could be outperformed and has been a couple times in recent years, as we saw record all-time highs and just incredible run-ups in stocks that even private companies couldn't match. But over time, our best minds think that they have the highest chance of outperforming, and it really functions as a portfolio diversifier for us. So kind of like an adage in the investment industry is there's no such thing as a free lunch, but if there was, it's diversification in investments. We really try to spread out and not be so overexposed in one area, certainly not in one particular vehicle, but in all the segments and asset classes. We want to get spread out, and this really helps. And I think the big thing that we stressed to the board was that we see this as tapping into like whole different sectors of the economy that doesn't always, but is somewhat decoupled from the performance of the biggest chunks of our investments. It's not working in the exact same field as bonds and stocks. And so gives us access to different pieces. We're especially interested in moving more into some venture investments, which is, those earliest startups, the ones where, 9 out of 10 fail and make $0, lose money. But that 10th one is Facebook or, whatever. It becomes like a household name and really can, do that kind of 100x performance. So, yeah, I mean, well, don't get me started. Okay, we got enough problems with that one right now. But that's the general gist here. And so we're looking, we just think that it strengthens the portfolio through diversity, and all things being equal, we're optimistic that it will outperform over time. So that's the rationale. Some folks vigorously disagree with every last word I just said. This is the current adopted strategy of the board. This is our primary answer to the question of what's your strategy to earn 6.8% when everyone thinks that you can't. This is basically the answer: is more, not just keeping money, but more allocation to private assets. So the top two people in our investment shop that we've hired here in the last 2 years, which is our number 1 and number 3 person overall, they are quite simply private market pros. Like, that is the game. They are not really like the stock market piece. The bond piece runs relatively mechanically. This is the action right here. Oh. This chart I threw in, this is from our recent funding levels and risk report that our actuarial shop puts out every year, which is really a broad look at all the kind of like employers kind of clustered together by public agencies, by school, by state, but that's kind of the breakdown. So this is not Redondo Beach. This is no one particular city. This is kind of an average sample city that we're looking at here on the right. And on the left is the funded status for the PERF, which is the Public Employees Retirement Fund. This is the big pot of money that you and everybody else is paying into. This is the $500 billion one. So what this chart is trying to show is really the enormous difference that investment returns make over time, even when we're plus or minus just 1%, just 100 basis points. So the middle line of sort of like looking into the left of the chart, what you're seeing here is, the middle line of those three from the colors, that is the actual investment. This is the actual target rate of return, the discount rate, 6.8%. So you can see the massive dip from last year. We went from over 80% to just over 70% in 1 year from that rotten negative 7.5%. So that's the drop. This is saying, what if over the next, how far does it go here? I've got my chat box up right in the way. Over the next 10 or so years, if we were to return 6.8% on average every single year, we would get up to an overall funded status of 87%. If we got just 1 percentage point better on average, all the way up to 94% funded for the whole system in just 10 years, and if we miss it by just an average of 1%, just 80% funded, a massive, basically a 7-point swing every year there. So that's kind of the story in a nutshell, is like how impactful investment returns are. Far bigger impact than anything on the actuarial side, like salary projections, inflation projections for cost to the system, cost to employers, how long people live. All of those things are interesting and meaningful, but they do not move the dial a fraction as much as what is the investment return. That's the game for us.
David, so our UAL, I'll call it the PEPRA effect, that will come in as far as the UAL for employers, slowly getting over that hill and maybe declining a little bit based on a preponderance of PEPRA employees versus classic employees. That's not a significant portion of that number?
It doesn't hold a candle to the impact of investment returns. No. It's not nothing. It's not nothing, but I would say that, if CalPERS could earn, if we could guarantee closer to like a 9% return or something, we would take that and make, this is like, would never happen, but we wouldn't worry about every member being a classic member forever. I mean, if you could earn 9% or 10, I mean, it would offset everything. That's just the biggest, it's by far the biggest, dial on the dashboard.
Just think it might move the number a little bit earlier based on the employer's unaccrued liabilities being lower.
Yeah. And, it pretty shockingly, so PEPRA took effect January 1 of 2013. So still less than 10 years ago by a little bit. And by like 3 weeks, I guess. And already nearly half of all active members are now PEPRA members.
Wow.
So it's happened very quickly. There's been a lot of retirements, perhaps spurred on by COVID, but even before then, we were over 40% even before COVID. It's happening pretty quickly. Not quickly enough. I want to hasten to say it's not happening fast enough to where employers should say, oh, we'll just wait for the egg to go through the snake kind of here and like just everything will be fine. Like the next 10 years are still immensely consequential and problematic for many employers, but it's happening. So there's some light at the end of the tunnel, but it's too far away to really breathe too big a sigh of relief. Anyway, the last thing that this chart is showing here is the same kind of like three scenarios. What if CalPERS did exactly what we expect, 6.8% returns versus 5.8 and 7.8. But here is the impact on employer rates. And for this side, things going down is good. Okay. How much money you have to pay to CalPERS going down is a good thing on this side. And again, you can see that if CalPERS would just, if we earn 1 percentage point on average higher, you save, almost 8% difference in terms of percentage of pay that's going towards pensions. That could be, tens of millions of dollars a year, depending on, where the city ends up. And, miscellaneous is the exact same thing. It's just those plans just aren't as expensive. And so you don't see quite the dramatic effect, but it's the same principle. Here, I'm just kind of wrapping up the sample stuff here, just the impacts. Again, the main narrative I'm trying to push here is just investment returns are everything, basically. What you're seeing here is 3 different projections that were all true at the time, but then investment things happened and they changed. So the kind of greenish lines are a safety plan, not your city, but a safety plan, representative safety plan. You can see that the dark line, the dark heavily bolded line, that's the projected percentage of payroll for a sample city for a safety plan. You can see that it's trending upwards. The line at the bottom of the green pile, where the beginning of the arrow line is, that's where things look to have been going just 1 year before that. After the 21.3% return, projected rates not just not going up, but going down sharply. And then it all reverses in just 12 months and, shocking difference in projected contribution costs over time there. And then the blue lines are just the exact same story being told on the miscellaneous side. Not quite as steep on this one. In fact, like they start to trend down eventually just by the nature of how long miscellaneous employees work and how their formulas are set up. But the meta narrative is the same, like just huge outsized impact of returns on the costs. And this is why we at CalPERS feel so much pressure and obligation to, return as high as we can with a acceptable level of risk, because these decisions cost tens of millions, hundreds of millions, billions for the largest plans like the state. They have real life costs. So why don't I pause there? The next stuff is going to be moving into the city's specific costs and plans. So if there's any questions on kind of like the grand stage and what's our overall strategy, happy to take those now.
The last time you did the asset allocation was when? The asset
well,
allocation you showed us, you say you do that on a 4-year cycle. So when was the last one done?
Yes. November of 2021. So slightly over 1 year ago was when those were adopted. Okay. All right. So let's look at the city's plans and kind of unpack a little bit what was done and what kind of like where to find the information if you're curious. And this is where, happy to take your direction on that's too much detail or that's too little detail. So first thing, just quickly defining the two key terms that we need to know about, really three, but the two elements that go into the pension costs, which the proper term there is employer contribution. So that's how much the city owes to CalPERS every year to account for pension costs. Those costs are broken up into two parts. I'm not going to say halves, but parts. And they're calculated different ways. The first one is called the normal cost. And that is the ongoing yearly cost of your current set of active employees that and this, just boiling it down here, this is roughly the cost for those employees' future pension costs broken down by, if we divide the amount of years we expect those people to live, frankly, and draw pension checks, you kind of break that down and divide that to the same percentage point as 1 year of work time. That's the normal cost. Okay, so like, what is the ongoing cost of calculating a pension for your active employees of the city right now to essentially pay for basically 1 year of retirement living? It's not 1 year, it's one commensurate fraction of how long they will be alive and earning pensions, but it equates to 1 year of work. Okay, that's the ongoing cost. It's not negligible by any means, but I believe I speak the truth when I say that the normal cost is not the problem. The normal cost is not the main concern to almost every city. The real problem is the unfunded accrued liability, the other half of the equation. It's really more commonly referred to by the acronym, which is UAL, unfunded accrued actuarial liability. And so this is really the debt that is generated when the CalPERS does not hit the expected returns that your pension contributions were calculated on. So if we expected to earn 6.8% in a year and we earned negative 6.8, which is pretty much what we did, then the city basically gets an unfunded liability, essentially like a charge on the credit card for all intents and purposes. And so just like a credit card, you could pay it off in 1 year, but if you then go out and buy stuff, which is what happens here, then you do rack up a balance. But it's more like, I may have used this example with you before, it's more like you bought a watch on a credit card and you paid off that credit card, and then the cost of that watch went up later and you owe the difference. And you're like, wait a second, I bought this watch for $200. Now you're telling me it's $250 and I owe you $50. That's more like it, really. Like that's kind of how the UAL works. But what's happening here is it's the price of the pensions, and the only time that they go up is when CalPERS doesn't hit its investment returns, or there's large changes to the demographic assumptions, the how long people live, what the expected salary increases are, things like that. And those are somewhere like 20% of the problem. It's like 80% of the issue is investment returns, discount rate, like that side of the equation. So that's just level setting here, so you know what I'm talking about. The normal cost doesn't go away. The city cannot get rid of its normal cost, and you know that better than most. You paid, I want to say it was $200 million. I looked it up through some of your documents, but I want to say it was over $200 million total.
229.
Yeah. So, and you still will have the normal cost forever.
22.
Yeah. The normal
222.
cost by law. Yeah. So a lot of money here, and yet the city will always have that normal cost. There's no way to get rid of that. That was part of the PEPRA changes from Governor Jerry Brown, is trying to get away from what was kind of derogatorily termed pension holidays and contribution holidays, because the idea is that no matter how good it is right now, at any given year, there could be down years, and it's better to have a surplus banked. So anyway, that's what your city had. You just had really bad luck with that negative 6.8, but you had banked a surplus. Anyway, so those are the core elements of the contributions, so just so you can understand. So the next few slides are going to be pretty text heavy, and I relied on your actuary. By your, I mean, he's a CalPERS employee, but all cities have like one kind of like senior actuary who oversees them, and kind of got this work from him. Any questions or comments? I thought I heard somebody start before I get into this. Okay, so one of the confusing pieces here is that when we talk about points in time, I'm going to be mentioning what's called a valuation, the actuarial valuation. This is a between 30 and 70 page document that CalPERS actuaries generate that is essentially a bill for the city, which also has some projected future costs. These things come out and they're dated based on kind of when the content that they have, but there's always a delay. They're never going to be real time. So for example, the city has like your most recent valuation is the June 30, 2021 valuation. That's what it's called, the 2021 valuation. But you guys didn't get that until August of 2022. And it's mostly talking about things happening from 23 onwards. Okay, so it gets a little bit confusing here. My guess is that your city manager and finance director have done a better job than me of explaining it, even because they deal with it all the time. But that's a confusing piece, is that the document itself, the valuation, is kind of like time-stamped for when the work was happening and reflects forward there, but it doesn't actually get into your hands until a year later. And then most of what it's talking about is a year after that. So it's kind of on a 2-year lag.
How often do the actuarial assumptions get reset?
Well, let's see. That's not quite the same thing I was going to add. So the valuations come out every single year. The actuarial assumptions undergirding all of this are also done on a 4-year cycle at the same time as the discount rate.
Okay.
So there were some changes to life expectancies going slightly down this year. Pretty minimal, but yeah, it happens at the same time.
David, quick question. You show on this chart negative 7.5 asset return gross of administrative expenses. Give us a feel for how substantial those administrative expenses are. How large is that, and how much does that change this negative 7.5?
They're low. So for us, I mean, our overall expenses are less than 1% of the budgets. It's a little bit like there's our administrative expensive, and then there's the investment office expensive, which is a little bit higher. I should have to pull that for you. This right here, though, going back to one of the first questions that you asked and others about, like, what's the right terminology and how do we grow? Even this right here, negative 7.5% asset return, gross administrative expenses. I mean, the numbers are right. It's just like the terminology. For asset return?
Well, portfolio return, that negative 7.5 is the portfolio return. And we're judging that against a 6.8 target. So if you get 7.5, negative 7.5, but you still have administrative expenses in there, you said those were kind of low, but then you also said something that didn't sound low, that was 1%. Could they be as high as 1% of the, could they impact this as much as 1%? Could this end up being a negative 8.5?
No. This is the end of the story on this number. This will not change. This is going into our annual financial report. This is going to be what's reflected in your next year's valuations, and that's what we're trying to show here. And that's why, you're actually kind of wrote the word approximate in there. It's there's some hedging here, just very slightly, but what we're trying to do here, anything that has to do with a non-official valuation, an actuary is going to say this is approximate, no matter what, even though we know for sure that it's going to be that number. It's just, you haven't received the valuation, and we're trying to show you some projections that aren't in evaluation yet because there's this 2-year lag. That's what we're trying to show here. But I can come back, and I think I should have done this because I want to say that I remember from a couple of years back, I think you asked the same question. I'm like, dang, I should have anticipated that. So let me get those. Okay. So this right here, this specific chart, it looks like something that would be in your valuation, but it's kind of a blend of them. So as you all know, the city made a monumental set of what's called ADPs from our end, additional discretionary payments. Looks like it came from a pension obligation bond. I think I read that you got 2.8% on that. So very good, great timing on that. What you're looking at here is, so starting at the top on the miscellaneous plan, which is your folks who are not, police officers, firefighters, et cetera, just the other city employees. Based on that, the report that you had, the most recent report, the actual valuation, your unfunded liabilities, and that's what we're looking at here, not the normal cost, but your unfunded liabilities are $0 next year and $0 out all the way. At this moment in time, the city had a $0 balance. In fact, you had a surplus, but that's not what's going to be reflected here. But it's just saying, what do you owe? The answer is you don't owe anything. And this is what I'm not sure if your finance director or city manager has shown you this yet, but the column under that where it says updated for fiscal year 2022 asset return. And so these are going to be, I guess you would say, unofficial numbers because they're not from a printed valuation, but they're going to be accurate. This is the new unfunded liability obligations for the miscellaneous plan there. Based on the known fact that we did in fact get a negative 7.5% return. We know that, that is information that we have, but it was not known when your most recent valuation report came out. But we know it happened, right? So this is just our attempt to try to give you a preview of what you'll see next year, because I'm sure the city will want to have this information and you can decide what to do or not do with your budget forecasting as a result of this. But that's what you're seeing here. Then you see the same thing on the safety plan. For a beautiful moment in time, there was no unfunded liability whatsoever. Now, because of the negative 7.5%, those are pension costs then that are real, that are back in play. And you can see, going forward as those get added in, and we have what's called a phased in or smoothing process. That's why it's not all the same every year. It sort of goes from, I want to say 40% of the investment loss is phased in the first year, and then up to 50, 60, 70, et cetera. So,
David, I'm sorry to interrupt. To Mr. Woodham's point from a little bit earlier, going back, let's say 10 years, if you can, what's the historical rate of return over the last 10 years to maybe bookend these numbers?
So I had that. Let's go back a little bit in the slides. I glossed through it, I think. So 10 years, the average of 7.7.
So it might be helpful to see that chart you just had up reflective of the historical rate of return as well. Understanding the old adage that past performance does not guarantee future results, but it would be interesting to see that concept within this current rate of return, the previous year's rate of return, and historical rate of return.
Interesting. Okay. Interesting. Well, I can say these ones right here, what you're seeing right here is based on an assumption of exactly a 6.8% return going forward from here. That's what the discount, that's the function of the discount rate when it comes to projecting employer costs in the future. Is you assume, even though we know it's almost certainly not going to be right, but you assume the discount rate will be what the city earns going forward. So that's what you're seeing here. We are not assuming that we would sort of spring back to, having a really healthy year of let's say 7.7%. It does not assume that. It does not try to pull in past performance. It exclusively predicts that we will hit whatever the discount rate is at that time. And it's 6.8% now. That's what this is.
So this shows the impact of having basically a 15% negative variance from what we wanted. We were trying to get 6.8 in that year. We got negative 7.5. So
Yes.
this is a pretty substantial deviation, and this shows the ongoing impact of that negative variance. And of course, this would
Correct.
change if in the future we have a positive return, a positive variance instead of a negative variance.
Yes. It will change if the results come in as anything other than 6.8% in
Yeah.
any of the next 5 years. Absolutely anything other than 6.8% will cause these numbers to change up or down.
I would have almost rather seen the historical rate of return rather than the previous year's rate of return. It would be more predictive.
Yeah.
It would still be zero, but it would be more predictive perhaps.
I mean, I just took 175 and divided by 6.8% and came up with about $2.5 million. So that's basically the amount of the liability, I guess,
Right.
unfunded liability,
Yeah.
based on the returns this year.
And so right now on this 175 and 463, we're back into paying, we're paying 6.8%
Yes.
of that to fund that liability.
That's right. That's right. So you took care of not just the lion's share, but just an enormous percent. I don't know what the percentage would be. It's got to be over 97% of the problem here. It's just at the time it was 100%, and now just through the performance of the markets and the return, you have generated in comparison to what it was in the past, a small unfunded liability going forward here.
And this is, of course, in addition to the service of the debt. on
Right.
Lease revenue bonds.
Right. So we, from our end, don't see that. I don't know what that is, but it looked like it was 2.8%, I want to say. And
2.8% of
good.
the 222.
Yeah.
yeah.
So these amounts need to be taken into consideration when
Yes.
the city's doing their budget, operating and capital projects budget.
And the other thing this particular one does not show that ongoing normal cost either. That ongoing kind of 1 year of pension service earned by active employees translated to roughly a year of retirement. Again, huge caveat around that, but that ongoing cost, that's not shown here. That is in your valuation. That's just kind of for all intents and purposes, the cost of doing business, sort of of having folks in a defined benefit plan going forward. And I kind of looked at it even when there's surpluses. Let's say that CalPERS had another 21% return year and you had an even bigger surplus, the city for sure would still have to pay that normal cost going forward. You would just continue to bank those surpluses against future years when inevitably there's a market drawdown. It just so happened that market drawdown occurred immediately the next year.
And that surplus is likely reflected for the 23-24 in the previous slide, the zero balance due. Is that due to the surplus that we had?
Yes, but honestly, if I were writing this for you, I'm not an actuary, but if I were doing this for you, I would have showed probably a different slide real quick here. I would have liked to have shown your surplus. In fact, since I'm the one sharing it, let me just pause here. And I want to share a snapshot from.
Because I want to know if the 24-25 number then is net of our surplus or gross of our surplus. We've got a zero for this 23-24. So carrying forward the next year, it looks like if we continued along in a negative, we'd have a liability of, say, a few $100,000. Is that reflective of the idea that our surplus has been thereby eliminated for the returns of the previous year?
Yeah.
Your surplus has been fully depleted already. Yeah.
By the end of the year, it was gone.
Right.
Yeah. Yeah.
Okay. So the second number for 24-25 isn't in any way mitigated by any remaining surplus.
Mm-hmm. It's just the 6.8, so it's basically just assuming
It's
that
still the assumption of the 6.8
Yeah.
of the shortfall. Okay.
Yeah. So let me just share this real quick. I won't go through all the plans, all the years, but I just thought this was pretty fascinating to look at. If you don't mind, let's see here. I need a bigger screen when I'm not in my office. I go from 4 screens to 1 and totally handicapped by it.
While you're doing that,
Um,
still, our lease revenue servicing our lease revenue debt plus any unaccrued liability going forward to 24, 25 is still far less than what our projected pension obligation would have been.
Oh, for sure. 6.8% versus 2.8.
Significantly
We
less.
locked into, save 4%.
Yes.
That's huge.
Imagine if we had to fund all this without doing the
Correct.
obligated loans.
Man, this may not be, the juice may not be worth the squeeze here, but okay. Are you seeing a valuation page now? The schedule of amortization basis at the top.
Yes.
Okay, so this is a screenshot from your most currently released actuarial valuation report. So this is the most currently released, but it doesn't have all the information that we have on the Zoom. It does not understand and know and predict the negative 7.5% year, what the impact was. But at this time, this was sort of like that beautiful moment. You can see here where it says final balance of, if you look at the very bottom part of the screen and kind of go over to the far right quadrant, the bottom right number where it says balance at 6/30/23, and then in parentheses, the 36.2 million, that was that surplus right there. So that's why I say it probably, that screen I was showing before where it says 0, it really should have said a surplus, an overage of 36.2. But it just got immediately wiped out as just through happenstance. Anyway, and there was,
Is this the UAL number only, or does this include the normal expenses also?
No, this is the UAL right here, and this is the UAL just for the. This is right in the way. I can't see. This is just for the safety plan. There is a similar one for. This looks almost identical, but it's not. This was the one for miscellaneous plan. Anyway, so this was just something I wanted to show. Like, there was a time, in print where the city could demonstrably show that you had.
Just want it in print. Frame it.
You got, okay, so that helps somebody. Okay, so that's what I was showing there. Okay.
David, quick question. For your assumptions, you went with the assumed inflation of 2.3%.
Yes.
Is that based on like extreme long-term inflation, meaning that you always use 2.3%?
No, it does change. I will say that this is an ongoing topic at CalPERS, because obviously we have seen I guess not unprecedented, but the quickest inflation to the highest point in, I want to say 40 years. So it's somewhere around 7% as a whole. And we're still sticking with this 2.3 long term. As I said earlier, we're committed to being on this 4-year review cycle, but that piece right there is straining our patience a little bit. It's a pretty wide delta between what we projected and where we are, and we're just not seeing signs that that's coming down very fast. So I may have to eat my words and come back in a year and tell you that demographic assumption is being changed off schedule. We'll see, but it is giving us some heartburn, that disparity between what we projected and where it is right now, because it's obviously way conservative.
Yeah, I agree. I wouldn't assume that it would be like, say, where we are today, but inflation generally doesn't move that fast.
Yeah.
So,
Yeah.
and I know it's a 4-year outlook. Maybe by the end of 4 years, we could be there.
Yeah.
Be a more likely outcome than
hope so.
to, by the beginning of this, or the average across the 4 years to be at 2.3 just seems a little unrealistic.
So
Yeah.
you might do an unscheduled reset. What precipitates something like that? An unbalanced portfolio?
A wildly inaccurate projection of inflation costs. I mean, that would, just like, because the market gyrations themselves, the investment returns, that can go anywhere in any given year. This type of like massive tripling up essentially of inflation is very uncommon, and the path forward is not really clear on that. So I may be speaking out of turn. This is really a decision for our chief actuary, but man, that we've got here a pretty discordant set of numbers versus what's happening in the real world. So we'll see.
How does the inflation number impact the calculation as you go? I assume that the salaries, the built-in salary assumption on salaries would change depending on inflation.
Pension.
They're tied together for sure. They're very much married together.
Returns should also factor into that. So if you change your inflation assumptions, then all of the things being equal, return assumptions for equities would increase as well.
Yeah, that's fair. That is fair. I will say we calculate them different. Like I'm not going to deny that they are linked in reality.
Percentage is not real dollars, so.
Yeah, and then for us though, they are our actuaries certainly calculate the inflation piece, and our investment guys calculate the asset piece. So I think you're correct on a philosophical level and financial level, but in terms of practical implementation, they're separate for us.
Commissioner Woodham, I would almost make the opposite argument, because to the extent that we have inflation in the future, that's going to erode the value.
Well, inflation certainly affects the economy, and it could cause the impact of inflation, and the Fed's policies to fight inflation could be pushing returns down. But if you talk to any money manager who's forecasting return on an equity portfolio, inflation is usually factored in, and for that model, higher inflation would result in a higher forecast return. It always does. Now, again, in practice, we could have higher forecast returns, and if we go into a recession, that would negate those higher expected returns. But from a forecasting standpoint, from the standpoint of forecasting, that 6 point, if we would go to a 4 or 5% inflation assumption scenario instead of 2.3,
Right.
then many things would change, but that 6.8% return forecast would also have to change.
I would think with higher inflation in the future than 2.3, then credit and cash is going to be in tighter supply, which is going to have a negative effect on the returns. And also future dollars would be worth less with the higher inflation.
But fixed income returns would be higher.
Fixed income would benefit, yeah.
Equities would be higher. Private, all the assets would. Well,
Okay.
I mean, we can, it's not a moot point, but it's.
The fixed income component, though, would probably lag
Yeah, it would.
based on your portfolio mix.
It would. But to the extent that you're forecasting,
All other things
in a
being
forecasting
equal,
model, the assets would return higher.
higher inflation has a negative effect on future returns.
Yeah.
Okay.
David, before I forget this point, what kind of reporting do we get here on returns from our portfolio? Do you send Doug and the finance office? Do they get monthly, quarterly reports?
No, there's the only official report that the city gets is this actuarial valuation report, which includes a lot of information on the performance of the fund and how the numbers were calculated, and those are inextricably tied to the performance of the fund. But there isn't an automatic kind of communication on investment decision making and performance that goes out to the employers. The information's available and housed on our website. There's our board items, which are permanently housed on the board site and available to the public.
No, I've taken a look at your website, and between you and me, it's very difficult to know what in the hell it says. So I'd suggest, with the liabilities that we're facing here, and I think I would speak for most every other city in the state and county, it'd be helpful to have that on a quarterly basis. We're making budget decisions And it helps to know what our returns have been, net of all expenses, and how that might impact our expenses going forward. We sort of view you, CalPERS, as both an investment manager and a consultant. The consulting part comes about in the asset allocation that you come up with that we buy into just because we're a member. So it'd be very helpful if you could come up with some sort of a report for this committee and all committees like it to show just that. At the end of the quarter, what's the return that you just had for the trailing quarter? And we're going to have that on for the last 20 years. Once you send us the data, those are decision variables that we need, I think.
Okay.
So if whatever you can do to help us on that would be helpful.
Okay. I hear what you're saying. The general position of CalPERS on that is that it becomes an exercise a little bit, in our opinion, politely, in futility to try to track it on for us, a minute basis quarterly, when it really is just the fiscal year return and ultimately the final return that matters. Because our view kind of is that people can drive themselves crazy trying to track the quarterly performance, and it truly means nothing to the city's contribution rates and projected costs until passes June 30th. Again, as I kind of started off today, I mean, the investment return last year this time was coming in at 13%. And I think our position is that it would not have behooved the city whatsoever to have that information and start making decisions off of that, given how, spending money, doing forecasts off that, when at no point did that actually change the city's obligations or projected costs. The only time that occurs is when those final numbers come in, and then that eventually then hits your valuation report. So I think our position would be that we would kind of be drowning you information that not only isn't really actionable, but can only lead to improper decision making, because it'll only be imperfect information all the time. That's the only thing we would know about it, is that it's not the right information because it's simply too early in the calendar to have it. That being said, any interested party, including the city, is welcome to that information. I think I would not be optimistic that CalPERS would be proactively generating that and sending it out. It would be more of a matter of the city coming to us, and I can direct anybody to where you can get as close to an accurate, daily read on the asset allocation and the performance and the assets under management. I'll just voice the position of the organization, which is that it's not going to be as helpful as we might hope.
Well, to your point, if you could get that information to Doug or someone in the finance office, so that if we want to ask that question, we can find it. Again, I simply couldn't make heads or tails out of the website. So if there's a way to navigate that, let us know, and we'd use that as the source of information. Thanks.
Okay, sure thing. Okay. We're nearing the end here. From my perspective, we can go, but hold on here. This one, not sure. I kind of want to hit this one here. So what you're seeing here, this one I like because it lumps in both normal cost and the unfunded accrued liability payment. So this is truly the CalPERS cost for each of your two plans, miscellaneous on the left and safety on the right. The way to read this one is each one of them is really two charts in one. On the left for the miscellaneous plan, and again, you're like, why is it so high? It's because it's the normal cost and the UAL. So the blue line, a line is pointing to the right side column of numbers, which is percentage of payroll. So on your miscellaneous plan, you can see here that in 2022-23, you're somewhere around a little bit less than 10% of payroll is allocated towards pensions, and it's going up slightly going forward, but not very high. The blue bars reflect to the left-hand axis, where it says $0 up to $7, which is really millions. And that's, again, so the actual dollar amounts that are owed to CalPERS for this plan, you can see they're a little bit below 2 million and then escalating up to a little bit over 3 million. So again, the ever increasing cost of normal cost until that sort of PEPRA scales tip over, until there's more and more PEPRA people than there are classic, frankly, more expensive members that will continue, then it'll go down. On the right side is the same thing, just on the safety plan, the numbers are basically doubled because those plans are more generous and they are more expensive to the city. But again, the blue line points to the right, and you can see that your percentage of pay is going from a little bit over 20% of payroll to right around 30%. And in terms of dollars owed to CalPERS, it does increase. Again, these plans have real costs, but this is much, much lower than this chart would have been, if we had this conversation 2 years ago, as a result of your massive ADP that you made. Anyway, so there's another piece that this is something that this does not reflect. This does not reflect the pension obligation bond being used to pay off the funds. So this was just sort of where you were as of the last valuation, where you kind of ranked compared to other similarly sized cities in California. This was an ask in a previous presentation I made to you all, so we just updated it. You can see that in terms of funded status, you were pretty close to in line with all other comparable plans, a little bit lower funded than other cities roughly your size on the miscellaneous side, a little, more or less funded. You weren't as funded as other comparable plans on the safety side. Obviously, these numbers are no longer relevant, as you are now far better funded than virtually any other city in California. So that's good. But you do, of course, still have the debt service on your own POB, but that's no longer part of this chart.
It's cheaper than what we were paying.
Oh, yeah. Lastly, for those of you who are interested in constant, you can continue to map this out. We have a tool called Pension Outlook Tool. This is free. This is available not just to Doug and company, but to any of you and really any member of the public. Anybody can do this. You can go to our website, I can send the link if you're curious, and you can model out specific to your city. You can look up the city of Redondo Beach miscellaneous plan or safety plan and run these numbers and say, well, what if next year we did get 21% or negative 21%? You can kind of be as optimistic or as pessimistic as you want. You can model out different discount rates. You can really change all the kind of like tools in the equation, and it will show you projected costs sliced and diced almost any way you want to. It's a very nifty tool. We built it ourselves at CalPERS, and it's free to anybody to use, and it's very helpful for future budgeting, especially for those of you who want to. You can fiddle with this and put in lots of different data points and spit out some charts that you can then bring to your council or just in this committee as much as you want. So that's all that I had to share. I think in terms of parting comments were that in my opinion, not as an actuary, but my opinion, I think the city has had very prudent decision-making and good timing, securing a very good rate on a large, debt service that then is paying off a higher interest rate debt. For a while there, you did have a budget surplus. Again, if we had not experienced that very negative return year, you would still have that surplus. That again, other points is that there's no realm in which you're not paying something to CalPERS every single year because of that ongoing normal cost. But you had a surplus briefly that got depleted, but theoretically, you could get a surplus again here. If CalPERS has a couple of really banner years in a row, it would probably take 2 in a row. But there's every possibility that you could bank surpluses again and keep your costs very low. So I guess I just want to, in my opinion, the city has been very forward thinking and bold and taken a big step towards, handling these costs for the defined benefit plans for the employees of the city. So I applaud you. It's just we'll see what the market has to say about it long term. It's out of our hands, but that was my read on it. So happy to take any questions here.
David, a quick question. You had mentioned, maybe a little gluttonous question, that about 50% right now are Pepra employees. Do you know what our current Pepra mix is in Redondo?
I don't. Hold on. Let's see. Let me.
And
I have your
absent that,
evaluation.
absent that, I
here.
understand you wouldn't have that at your fingertips, or possibly not. Curious what the trend line is that you're seeing for the Pepra line. Is it trending more quickly than you expected towards Pepra employees?
Yes,
50%, I would think so.
Yes, this is. I think our actuary said that we expected to be at about 30% right now, and we're at 50. So I mean, going much faster. Just retirement trends are the big thing there, and yeah, just a lot of folks leaving the workforce. And then I understand like there's not as much hiring going on now. I think a lot of areas are having trouble recruiting new employees, but for certainly before COVID, there was a big burst of hiring of Pepra qualified employees, and that's moving the needle. So every kind of like few percentage points of more Pepra is to the benefit of the employer because they are markedly less expensive. I think one thing a lot of folks don't know, or maybe you know, but I just want to point out is that not only is the Pepra formula less generous and it requires someone to work a little bit longer to get there, it caps the pension amount for those very high salary earners. I don't know about specific to your city, but the very high earner, I'm talking about that, occasional 200,000 to 250,000 salary income earner, 400. Like once you get up there are limits to what that person's pension can be that do not really exist for the classic members. So right now, most of those people in those very high paid positions are classic members because that's how careers were. They had to start a while back and they earned their way up. And I'm not saying they didn't earn it, but like most of them are classic members. In the future, a lot of these city managers and the fire chief and the other kind of like the top positions, they're not going to retire with the same kind of pension. And so that's a piece of it. And for us, that's good for pension costs, but we're a little bit concerned that it's going to hurt with recruitment and retention because there's going to be a point where someone says, well, I mean, I appreciate the salary here, but the fact is that working 3 more years isn't going to move the needle on my pension 1 iota. So they may explore other things. So that's one thing to kind of have in the back of your mind is that it's kind of like a double-edged sword, I would say. But that's kind of a problem for future Redondo Beach, I would say.
We were looking at one time at our curve, maybe starting a downward trajectory around 2032, 2033.
Yep, that sounds about right.
At one point. And if it looks like now that perhaps that curve might start bending in 2028 or 2029, it'd be interesting to see how that would affect our future UAL and what our obligations might be on that component to CalPERS in down years. So that's all just part of a bigger picture.
Yeah, that's interesting. I'm actually going to jot down. I know you didn't specifically ask for it there, but I feel like that's something that could maybe be an upgrade to our pension outlook tool that I just mentioned, our forecasting tool. Because right now it doesn't, of all the variables it has, kind of passing that tipping point on Pepra membership is not one of those variables that can be manipulated. So it would be interesting to kind of build that in there and see what that does to city cost projection. So thank you for that.
Good session. Appreciate it.
Thank you very much for
Absolutely.
coming. This is a great presentation.
You're welcome. My pleasure. Thank you all. Happy holidays.
You too.
You too.
Bye.
Public comment? Should we close
Should we
this
get you
item, Mike,
formally,
or
Do
Denny?
you want to do a formal motion to close it?
Any comments?
Any public comments, maybe, and then
Comments or?
There's no public comments.
I'll make a motion to receive and file J1.
Second.
All in favor?
Aye.
All
On J
opposed?
items, don't we need a roll call or are we just?
Sorry,
Yeah, we can, we should do a roll call for
Okay.
the discussion items.
no problem. Commissioner Conroy?
Commissioner Conroy?
Commissioner Castle?
Aye.
Commissioner Woodham?
Aye.
Commissioner Solomon?
Aye.
And I as well.
It's fine.
Motion to receive and file. Item J2, discussion with the city manager on the state of staffing and workload of the financial services department.
Sorry.
Thank you. Well, good evening, everybody. Nice to see you all. I don't think we've had a chance to meet yet, Commissioner, but pleasure. Thanks for your service. Mike Witsansky, City Manager. It's been a little while. Been trying not to drive our financial staff, our remaining financial staff too hard, which is why you haven't seen me in here as often. But I did think it was important to get here and kind of update you on where we're at with our staffing and really what our workload focus has been of late. Typically, this time of year, this meeting, in fact, one of your items would have been review of year-end carryovers and financial designations. We did not have that for you tonight. We are about 6 weeks behind in the preparation of our annual comprehensive financial report. That's due to a couple of things, but really most notably GASB 87, which is one of the new accounting standards requirements that has kicked in this year that has affected our city pretty hard as compared to our peers. What GASB 87 is, and I know Eugene has looked at this a little bit, it really speaks to our obligation to discuss certain lease assets and the status of leases in our community and now incorporate that into our annual review. For a city like ours, which has really hundreds of prospective lease assets, that is a really lengthy process. And our outside consultant, LSL, who has been evaluating our laundry list of leases, has combed through over 150 potential eligible documents. At this point, I think, based on my conversation with Lori earlier today, at least 50 of those leases are going to be necessary to be included as part of the 87 standard, as part of our going forward CAFR. So it's just voluminous information that has really bogged down the preparation of our draft reports. So what I can tell you as it relates to that is we typically try to approve our comprehensive report in December each year. First meeting of the month is usually a review with all of you. Council will then take a look and approve the designations and carryovers and encumbrances, and then we will make our final reporting as part of the act for at the end of the month. I'm now looking at that occurring likely in January based on where we're at. If there's a chance we can get a high-level annual report prepared on a fund balance basis for council on the 20th of this month, I'll do it, not because I want to bypass your input because it's super valuable, as you know, but we may need to keep the sort of trains rolling there. And if that is the case, whatever that report is that's presented to them, we will circulate to you and it will be subject to our conversation in January. I think it's your January 12th regularly scheduled meeting. So, but right now I can't even tell you that's a certainty. I suspect it's quite possible that our conversation with you all on January 12th will be the preview of that, and that will potentially be actually daylighting that with the city council on January 17th, and then later approving the act for at the either tail end of the month or in early February. So we are 4 to 6 weeks behind in our annual reporting right now. It doesn't harm us. It's an artificial deadline for us. It really is a matter of our own workflow. There isn't an accounting requirement per se to have it performed and approved in December. But it is something we strive to do because, as you all know, we get right into mid-year budgeting in February and March typically, and then we're presenting forecasting for our annual budgeting that I will prepare for you all in May that the council must adopt by July 1st. So it's a challenge. It's not been an easy one. LSL is stepping up and helping us. I have to really give a huge thank you to Lori and Doug, who are really driving this effort this year internally. And then thankfully, we were able to wrangle in our previous finance director, Marnie Rulin, who is helping us out on a part-time basis outside of City Hall and is helping accelerate our process. I shouldn't say accelerate, helping keep our process moving forward. So grateful for our staff. Really, Doug has done a tremendous job. Lori, it's just been a lot of work. This GASB 87 standard couldn't come at a worse time for us organizationally. But it's here and we're making the best of it. So if you would, just bear with us. I will try to get you all of the normal documentation that we provide as part of our annual reporting. As you know, a lot of that includes fund balance variances, revenues and expenditure variances by department, sometimes division. We may roll some of that up this year to synthesize our process and accelerate it. But I'll try to get you all the key information that you're usually accustomed to seeing. But do know it is going to be an unusual year to some degree because of GASB 87. So we could talk a little bit about that if you want now. The other update I wanted to provide you is where we're at with our finance director recruitment and kind of where we're heading there. But if you have any questions about the annual comprehensive financial report, I'm happy to answer them today.
Just real quick, so how much of the delays would you attribute to the GASB 87 versus how much of the delays attributable to our reduced finance department headcount?
You know, I think had the reduction not occurred, there was a window a couple of months ago, perhaps, to get out in front of this a little bit and to start some more advanced planning there. So part of the delay is due to that. There's no question, the reduced staffing. But I will tell you, we are going to be in good company with delays. In talking to some of our auditors, more than 25% of their clients are in the same position we're in, where they're likely to handle year-end designations in January and approve their act for shortly thereafter. So this is common, unfortunately, for a lot of municipalities right now, particularly those who have a lot of lease assets, as we do. So it's not, unfortunately, we're not that unique in this, but I can't tell you that we couldn't. I think there are ways we could have avoided this delay. I think had we jumped on the GASB 87 activity really in June and July, candidly, we would have needed to start that lease analysis process almost at the time we were adopting the budget.
Lesson learned. And I'm happy to hear Marnie's participating, helping us out. To what extent does that look like? Is she contributing 20 hours a week, 40 hours a week?
Yeah, she's limited to the 960 program as a PERS annuitant. So she has to be a little careful. She can't work more than 960 hours over the course of a fiscal year. Okay. I suspect we will have her work all 960 hours. It ebbs and flows a little bit. She might work 20 hours one week and a little more the next, or a little less than that.
So not like a full head count, though?
Yeah, no. She'd be a half-time. If you're looking for an equivalent, it'd be a 0.5 FTE, probably.
Yeah, because I guess I'm trying to get an idea of to what percentage roughly, not head count per se, but percentage is our finance department been reduced?
Yeah. Well, if you go to historic staffing standards, we're down about the equivalent of, call it 0.5, really.
So just half of a head
Just
count?
half of the, really half the finance director, if you will. But arguably there's significant loss in not having that. Right now, Lori's wearing basically two hats, assistant finance director and acting finance director. Marnie's helping pinch hit to a degree to soften that load on a half-time basis, roughly. Mm-hmm. But there's something lost, of course, in not having two dedicated full-time staff members that I would argue is greater than a half-time equivalent. What we did do this year, a position that we added to the budget that we haven't filled yet, is the senior accounting position. Mm-hmm. And we felt that was necessary to actually help manage some of the newer standards and really, we think, restore a staffing level that you all heard me describe in the last couple of budgets. So that position hasn't been filled either, in part because of the transition at the top. What we are working on, in fact, Lori and I just discussed this, we are probably going to bring on some contract augmentation accounting services to help us fill that gap. Out of fairness to the future director, we want to give that individual an opportunity to make that hire, but that need is now. So we'll likely be bringing forward a contract for some additional help there. It costs us a little bit more, but as you heard David mention, particularly as I'm reading it in the financial profession, municipal financial profession, this is a challenging time to hire. It's as difficult as I've seen in this particular area. I mean, we talk about police hiring and we constantly work that. We've had success there. We are struggling right now to recruit at that top end financial.
Really
level.
hard to hire right now.
Really is. For whatever reason, the generation that I think is skilled and prepared and ready to take that jump, we've talked to a number of candidates that just don't want to step into that leadership role. They don't want the responsibility. And we've got to find the right person that's willing to do that. So to that end, we have recently reposted the finance director position. I asked the council to up the salary a little bit to try to make us more competitive in the market. I don't know if it'll be enough, to be honest, given where we're at, but we're trying. I'm hoping to screen resumes here in the next couple of weeks. And with any luck, we'll have somebody on board here in the next couple of months. But it's been a challenge. It really has. The last candidate pool that I saw, we were not happy with, and we are bound and determined to make sure we make the right hire here. It's just too critical a position.
Is it primarily salary?
I think that's a big driver, but I think it's a dearth in the market. I really do. I think when you have really good, when you have a Marnie and a Lori in your organization, a Doug, you don't, for whatever reason, I don't know if it's the conservative nature of the business, you don't see a lot of municipal finance folks look to jump to other agencies. It's just not as common. You might at the top, you might at that revenue manager, finance manager, maybe assistant director level looking to take the plunge. Maybe they just don't have the patience to wait it out in their own organization. But for whatever reason, there's just not a lot of job hopping in the financial services world, at least in the municipal sector, in my experience. So, but yes, to answer your question, I think salary is not helping us. I have some tools and levers I can pull in our pay and benefits plan that can up that. The common thing I use is management incentive pay. There's an ability in our plans, or MOU if you want to call it that, that allows us to bring folks in at a slightly higher rate than the salary range itself that's posted. And that's really now what we're trying to advertise, because we just need every bit we can get. So I'm hopeful. We're out there. If you know anybody that is got government fund accounting experience that is interested, send them my way. I'd love to talk to them. We do not do the traditional, it's got to be a civil service panel. I mean, we will, I'll interview anybody on the spot and find out if they're interested and they're a potential fit. There's no candidate we won't explore at this point. So that's where we're at. I know that's, ideally I'd be here today presenting to you kind of year-end finances and we'd be talking. I will say this, I can give you a little bit of a preview. The early general fund balance numbers look pretty good. They look okay. I think we'll have excess fund balance to allocate. But I will tell you, I will probably be recommending that any surplus beyond adopted budget be squirreled away and likely set aside to help us with either future issues and or salary need throughout the organization, just based on what we're experiencing. So.
I'm sorry, go ahead, Jason. I was going to say, the CalPERS report that you saw tonight, was that information that you hadn't seen previously?
Yeah, that chart, so what he gave you at the tail end was based on our conversation earlier today, because what I had asked and what I've been eager to see, and it wasn't in our original actuarial report, is we should have, somewhere I should have seen a posted credit. We should have seen a posted credit. I know the timing of our payment was beyond the 2021 cycle that was so positive, where they had, the 21+% rate of return. But for a little while, there should have been a credit, but we're already jumping ahead to the new supplemental UAL. And it's like, God, it's just, I wanted to see that posted somewhere.
But that was the first time you saw it in the future, the anticipated future UAL.
UAL,
right?
yeah. I knew there was going to be one with their rate of return this year. I figured it would have wiped out our surplus, because that's a big swing. And it's a couple $1 million. I don't think we'll pay it out over time. That we've got still a little under $6 million in our pension reserve account there. I think we'll want to apply whatever we need out of that to just pay off the UAL and be done with it when we do receive the bill, which is still a year away. Mm-hmm. But yeah, I can tell you those charts, and David wasn't right. He he was spot on when he said, if you had looked at that chart today, that UAL total cost with normal cost included versus what that chart looked like 2 years ago, I mean,
At the risk of sounding pessimistic, I would look at that as kind of towards the best case scenario.
oh, no doubt,
Yeah.
no doubt. And what is, I'm just pleased with is we're seeing single digit millions in the left column. I mean, those numbers were 29, 30, 40 million dollars in our last, charts a couple years ago. So, we did the right thing with the pension.
Mike, you just answered one of my questions. When David was talking about, or Jerry was asking about quarterly reports, to get an idea, would you find it helpful for us to see quarterly reports?
I think it's a good question. I'm always hopeful to read about and hear that, hey, PERS is doing well with investments. I'd love to know that they're doing well, but I don't disagree with David in the fact that we just in our budget counter, we can't react constructively to a quarterly report. It would be good to know, to feel confident or optimistic or slightly, less pessimistic or whatever it might be. But he's right. For our purposes, I would love to see more real-time reporting. We deal with such a lag. We're getting actuarial reports that are, but we get them, typically the circular comes out in August. Sometimes it's been as late as October. And that's 14 to 16 months post dated. And it's giving you a forecast for not even your next fiscal year, but the one after it. Mm-hmm. It feels sometimes like a bit of a shell game. And that's why I was so, and it's not, I know that, but it doesn't come across as a very straightforward tool. So I'd like to see some more real-time reporting. I mean, to feel optimistic, it wouldn't change the way we budget, but it would perhaps change our optimism and pessimism meter as we look towards future expenditure and forecasting.
The thing it does is it impacts discussions such as the one we had here last meeting and the meeting before, where we were talking about the possibility of borrowing money for capital projects.
Well, true.
If we know ahead of time that we're already sucking wind,
$2 million in the hole.
right, then it really impacts those discussions.
I hate to say it, one of the thoughts I had here, just looking at supplemental UAL and okay, they've changed the discount rate to 6.8 now. We're going to leverage ourselves more into privates. Like it does. And I can tell you there's a report we're waiting on, and you all know this, we're doing a comprehensive class and comp study for where we stand in the marketplace for salaries. We've been very austere over the last decade here in Redondo with salaries. Police and fire, we've tried to stay within market. I think we've done okay there, but miscellaneous employees, not so much. And I am worried about the data that comes out in that report, driving our need to probably apply more of our revenue increment towards future salary increase just to keep up. I mean, we're already feeling the pressure with inflation.
That brings up so you're familiar with the new 2023 California law where postings have to list a range, and also current employees, if they're requested, are to be given a range for the job they do. I wonder, does that affect municipalities, or is that just private?
We typically have acted in that way.
Already?
Yeah, we typically post with range, or historically have. There are a few positions in our organizations that have step increments that we may have to adjust that under the new law. I haven't studied that part of it yet. But for the most part, that's how we advertise jobs. Unfortunately, and sometimes that's not a great draw for folks because they see the top of the range and.
Yeah, but everything's increased.
And it's got to, and our ranges only go up when we change and we negotiate, meet, and confer on new bargaining and MOUs. And so we've got dedicated, we have planned 2% increases for our miscellaneous employees in January. We are in negotiations with our Police Officers Association and Police Management Union now. So we'll be daylighting, those changes at some point, but I'm fearful that we are significantly under market on the miscellaneous side, and there is real wage growth pressure that we're going to need to meet.
Are you seeing that issue in terms of retention?
I'm sorry?
Are you seeing that issue in terms of retention?
Absolutely. Yeah. I mean, I shouldn't say retention, probably more recruitment than retention. Okay. Once people come into Redondo Beach, I don't know what it is, if it's our all of the charm of our commissions. But,
Clearly.
yeah, typically, you know, our folks
one else
tend,
dresses like
they
this.
tend to stay. I mean, our wild dressing, I mean, they tend to stay, which is good. But, you know, that has a limit. At some point, you know, money talks. We all know that. And with inflation and where it's been, our folks are feeling the pressure. They're really feeling the pressure.
I want to go back to a point that Jerry made a moment ago and go back to GASB 87 for a second. So the way that the GASB asks, we're very interested, this panel, in the infrastructure bonding and the conversation that was had, and we were hoping to have more conversations about that. Everybody here has talked about having more of those conversations. The GASB 87 and the way that the leases are being booked as assets and liabilities or liabilities could impact that credit rating, to your point, Jerry, about what we are looking in the future, because as it might affect our credit rating, it might affect our cost of bonding. So the way GASB 87 affects the way that we're booking assets and liabilities of our leases could affect our credit rating, which then affect our cost of bonding going forward.
It could potentially. I mean, you know, my experience in dealing with the credit agencies, they do a deep dive. You know, we do the interviews, they look at the annual financial report, they're looking at the different metrics. They have a handle, certainly on any leases that speak to debt. But yeah, I mean, that's a real issue. And I'll tell you, I've wanted to align the bond conversation, potential capital infrastructure bond conversation has been brewing. But what I've tried to caution all of us on is we really need to look at that in the context, and this is to your point, in the context of, structural revenues and expenditures. Whether or not we can go out and take on another $2-3 million in annual debt service when we might have other needs, particularly on the employee side, to just keep up. I do worry about it. The last thing I want to do is see us strain our resources and then not be fully contemplating what we have on the future growth on salary. I think we should continue to have the conversations. I'd like to bring them back to you, but we should have them when we're also looking at year-end financials. And I think we have a good handle on where we're at structurally, and with a reasonable forecast over the next 3 years. Because I just want to make sure we've got money in different pots to meet our primary obligations.
Definitely the CalPERS presentation was something we were all anxious
Oh yeah, this is great.
to have
This is
again.
good.
And then the infrastructure conversation was something we were anxious to have again. So thanks for putting that in context as far as what's going on.
Yeah, I wish we had year end for you tonight. I really do. We're behind, but hopefully June or January, and we'll get back at it. And
Does the city have a deadline with LSL to complete that audit as far from a state requirement, or you said that's an internal deadline?
it's an internal deadline. What is it now, Doug? 10 years in a row, 12, 18 years in a row, we win the county.
It's been more than that.
What's our award? What's the
20
award
20
called?
plus years.
Yeah, what's it called?
GFOA
Award of
award.
Excellence? GFOA, Budget
GFOA,
Award of
Financial
Excellence.
Award of Excellence.
Yeah, we thankfully, we've been fortunate to have that award running for a long time now, in budget preparation, delivery and all that. One of their criterion is typically the timing of your delivery of your annual financial report. They prefer to see that in December just because of the logical nature of it. They themselves, though, are experiencing an uptick in requests for extensions into January, which we did file for. So we're hopeful that they'll recognize the need for delay as well. But no, it's really an artificial deadline. It just happens to work well with the overall calendar, because the delay for annual, this is really the precursor for us to then turn to January, prepare W-2s, get all of our annual tax documents done. February, we start looking at mid-year. March, we start projecting and forecasting for May budget delivery. April, we're considering expenditure requests from departments. May, I'm delivering the document. June, we're deliberating. It's just, there's no rest for the weary in the financial world. So not in the government accounting financial world, I can tell you that.
Just so you're aware of it, we've had this discussion on the commission before. we should have the annual presentation from CalPERS. This commission should have a closer relationship with the folks at CalPERS just to keep up with what's going on.
I love it. I mean, the fact that this is David's third time doing it, right? I think. Is that?
Third time or second?
We had David or someone comparable to that talk to us before we did the bond issue.
Yeah.
I don't know if it was him or not.
I know we've had David twice.
Yeah.
Yes, I love it. I couldn't agree more. And he seems, I'm thankful he seems receptive to it. You know, the PERS didn't invest in him. I don't know what David Styles ambassador, PERS ambassador or something. But I think it's great. It's a great tool. PERS to me has been in my entire career has been an enigma, really an enigma. And I think they're trying to demystify it a little bit, which I appreciate. But yeah, absolutely. We'll do everything we can to facilitate an annual presentation. I just think it's worthwhile. Yeah. I just hope he's got better news for us next time.
He's refreshingly candid.
Yeah, he is.
About
I think he's great.
His
Yeah,
own opinion on things.
yeah, really do. Really helpful.
Insights into that.
It's not just a canned presentation droning on. He weighs in and is responsive. I really appreciate that.
And it seemed like he even got a couple of things out of the conversation with us. So
Oh, I think so. I mean, you guys have asked him some pretty good questions over the last couple of years. And he was prepared. We had a good conversation earlier today. He was receptive. He was curious. We're an interesting test case, right? We delivered a huge payment.
Paid it all off.
Paid it all off, right? We were 100% funded and that was right on top of a good year. I wish we had paid it off, before the good year, but of course our debt service costs would have been much higher. But yeah, it was,
Other cities have done that, but just not to that extent, not that number.
well, Torrance wrote a pretty big one. I think they were I think they did a $300 million issue.
Then their debt service must have still been kind of high because they had their tax measure
They did.
that came through, which was allegedly to be allocated towards debt service for their pension.
In
Not the
large part.
bond, not the bond service, but
Yeah.
still further unaccrued liabilities.
Yep. And covering existing salary costs. Yeah, they were, I think, staring at significant cuts otherwise.
I'd like to thank our pension debt guru, Jerry Woodham.
Hey, Jared sat on the interviews. I can't thank him enough. It was fantastic. It was a great outcome. I think our team was great. We killed it, 2.8%. I mean, my gosh. I mean,
Saving that 4
that
points.
spread on that discount, I mean, oh my gosh, that's big money.
Imagine where
$100
we'd be.
million bucks, we think, over 20 years.
The life of it, yeah.
So, no, it was great.
So going forward, Mike, for us, as far as planning and things that we see on a regular basis, it sounds like some of those things were obviously going to be a little bit delayed. Other things that maybe we've been working on won't be coming back in the near future, or things that we're asking about, like infrastructure bonding and things
Yeah,
like
I
that.
could see us getting to infrastructure maybe maybe in February.
Okay.
I could see that. I think at some point, we'll be in front of you probably talking about internal service fund again, and maybe compare and contrast on, kind of fire department costs, things like that. I could see this commission playing a role in that too. Perhaps this spring, maybe even earlier than that. But other than that, it's just to try to get back to our regular calendar. I mean, you'll be really busy here again and with mid-year in March. And I mean, we will probably do mid-year in March this year as opposed to late February. I don't think we'll get there.
So we should probably expect our normal special meeting in May for budgeting.
Yeah, absolutely. You're May and June for you gets really busy just with the normal budget discussions, especially now that we've got you involved on the front side of it. So you'll be busy there. I think really the opportunity for kind of the, extemporaneous discussions, is really February, March, I think, maybe April. So.
Well,
Anyway.
good luck in your job, your search for our next finance
Yeah.
director.
I'm looking, if you know anybody, send them over. We're on the hunt. So, but no, it's big thank you to Lori and Doug really, and all the team just for kind of keeping it rolling.
Do we do any, do we have any internal recruiters that maybe reach out to directors of maybe smaller
We
cities? or
do.
different-
It's kind of, a lot of hiring's been word of mouth. I mean, I could think, Pat, our recent fire chief, it is just me, talking to people, us talking to people, our team talking to people, Waterfront Economic Development, Greg Kapovich. Another one, the two staff members in my office, Luke and Elizabeth. I mean, typically, we're able to, through the professional circuit, kind of mine prospective candidates, but finance, for some reason, it's tougher. I don't know what it is about the profession. They don't get out as often. I don't know. I got to figure out a way to get to them. But
There's a specific silo of person.
yeah. But I've even thought about if this next round doesn't quite work, I thought we might have to bite the bullet and recommend that we use a search firm to kind of help and really extend it out. Bring in a Avery or a Bob Murray or one of the Peckham, McKenna, kind of deals, and have them do an executive search for us. I'm going to be going out for the IT director here as well pretty soon, so I might bring him in and have him do both. But
Get a deal
I keep my
on
fingers crossed for now. Yeah, exactly. Yeah, 2 for 1.
Do you have an idea, going back to the CalPERS discussion? So it sounds like we're having a lot of turnover lately for different reasons.
Yeah, positive turnover. I mean, our Pepper numbers, definitely in safety is at that 50+% number. Safety, it's just this generational change. We're organization-wide, we might not quite yet be at 50%, but I wouldn't be surprised if we are. We're right there.
So not holding your feet to the fire, but it might be a situation where we outperform that expected 2032
We could.
turn.
We could, assuming, PERS the investment world doesn't, continue to blow up on
Right.
us. Yeah, I mean, we could be okay. But I will say, they did adjust actuarial life expectancy down,
That's COVID related though,
That's
right?
COVID related.
Yeah,
I
so
think that's temporary. I mean, our police and firefighters, when they retire now, there was a time, we've talked about this here. There was a time a police officer would retire and their average life expectancy post-retirement was under 2 years.
Wow.
Firefighter was, not much greater than that. Our firefighters now and officers retire, they got 50+ years left in them. I mean, it's so, that actuarial figure and that cost is expensive.
That's when CalPERS worked.
Yeah, well, that's what caused that whole big pendulum swing to just change the whole formula, right? But I will tell you, he is right about one thing. I've started to see that on the executive side of recruitment. Classic members have no trouble coming over, classic pension members coming over and continuing to work. But if you're an executive now, let's say you've come in from the private sector and you're a Pepper member, I've seen those folks make retention calculations that are different. They're not as invested in hanging in. So
you sweeten that with OPEB or something like that?
I don't know. We'll have to wait and see. I do worry a little bit about where we're heading, and I think about future city managers, department heads. It's always been in this profession. There's kind of slow and steady wins the race. And if you have an ability to kind of climb in the profession, there's real incentive for you to do that. That changes now. I could see folks in my field jumping out mid-career and going and doing something different just because they've already reached their pension threshold.
Private industry, you mean?
Yep, absolutely. So, that could be a problem for future municipal leadership. I don't know. It'd be interesting to see how it plays out.
And has there ever been chatter about reforming the Pepper reform?
Not yet. I mean, I think we're still too young into it, but the fact that that's even being talked about at PERS tells me that there's some discussions up in Sacramento.
We're not quite 10 years into it.
No, right. We're only at year 9. So I do wonder about that. There's still a few classics out there hanging around. We're not out of the organizations yet, but another few years it could change. So anyway.
Any other comments?
Anything else?
Questions? Doug, any?
There are no comments on Zoom and there's no e-comments.
Well, I'll see y'all in January. I'll be here on the 12th.
Get a motion to
Thank you very
receive and
much.
file?
Happy holidays to everybody. Nice to meet you.
You too.
Yeah, appreciate y'all.
We appreciate
Thanks,
you.
Mike.
Okay. All right, guys.
Thank you.
Need to do a motion to receive and file?
So moved.
Second.
Doug, can we do a roll call? vote?
Sure. Commissioner Conroy,
Aye.
Commissioner Castle.
Aye.
Chair Marin,
Aye.
Commissioner Woodham,
Aye.
Commissioner Solomon.
Aye.
All right, motion passes. Item K, member items and referrals to staff. Commissioner Conway?
I just want to reiterate to Doug and the rest of the people in the finance department, how much we appreciate all the hard work you're doing and dealing with, being short-staffed and these additional requirements. We all appreciate it very much.
Appreciate that. Thank you.
Nothing from me.
Quick question. Do we have, do you have copies of the slides we saw tonight?
Yeah, I have, I could forward that on to you after.
Could you shoot us all a copy of that for?
Sure, I'll send it to everybody.
I was taking pictures of my screen.
I was trying to do that.
That's all.
Just want to say thank you to everybody for the year. Really appreciate the commission and all the work that everybody does. Thank you to Doug. Ditto on that. Jason's comment. Everybody enjoy the holiday season. Be safe. And see you in 2023.
I need the number of your tailor.
Tipsy elves.
Right.
Sounds good. All right, we'll see everybody in January 12th.
Make a motion to adjourn.
You adjourn.
Motion.
I'll make a motion to adjourn.
I'll second it.
All in favor?
Aye.
Aye.
Thank you.
All right, great. Thank you.